What if you could invest in the US stock market without compromising your values? Today we are looking at one of the most popular halal ETFs available to investors, SPUS. This ETF is often seen as the go-to option for Sharia-compliant exposure to large US companies. But is it actually a strong long-term investment or simply a filtered version of a traditional index? In this video I will break it down in a simple and practical way. We will look at how it works, what it holds, its performance, and the key risks you need to understand before investing. Let us start with the basics. SPUS is an ETF listed in the United States that aims to provide exposure to large-cap American companies while following Sharia-compliant investment principles. It is based on a modified version of the SP 500 but applies a screening process to remove companies that do not meet Islamic finance guidelines. This means the fund excludes businesses involved in interest-based financial services as well as companies with high levels of debt or revenue from non-compliant activities. As a result, SPUS ends up with a different composition compared to the traditional index. It tends to be more concentrated in sectors like technology and growth-oriented companies while reducing exposure to financials and other excluded industries. For investors, this creates a unique profile. You still benefit from exposure to major US companies but within a framework that aligns with your values. However, it is important to understand that these filters also change the risk and return characteristics of the portfolio, which we will explore in the next sections. Now let us understand how SPUS stays Sharia compliant. The fund follows a multi-step screening process designed to align investments with Islamic finance principles. The first step is industry screening. Companies involved in prohibited activities such as conventional banking, alcohol, gambling, tobacco, and adult entertainment are excluded. This removes a significant portion of the traditional market. The second step is financial screening. SPUS evaluates key financial ratios to ensure companies do not rely heavily on debt or interest-based income. For example, companies with high leverage or significant interest revenue are filtered out. This is important because Islamic investing avoids excessive debt and interest-driven business models. The third step is purification. Even after screening, some companies may still generate a small portion of non-compliant income. In that case, a purification process is applied where a small amount of income is identified and should be donated by investors to remain compliant. Overall, this process creates a portfolio that is aligned with Sharia principles. However, it also means fewer companies are included, which can impact diversification and sector exposure compared to traditional ETFs. Let us now look at what is actually inside SPUS. The ETF focuses on large US companies that pass the Sharia screening process. Because of these filters, the portfolio is quite different from the standard SP 500. One of the most noticeable differences is the strong concentration in technology and growth companies. You will typically find major names like Apple, Microsoft, Nvidia, Amazon, Meta, and Alphabet among the top holdings. These companies tend to have strong balance sheets, high profitability, and lower reliance on interest-based financing compared to traditional financial institutions. At the same time, entire sectors such as conventional banks and many financial services companies are excluded. This means SPUS avoids companies that usually make up a significant portion of the SP 500. As a result, the ETF is more concentrated and less diversified across sectors. For investors, this has both advantages and drawbacks. On one hand, you gain exposure to some of the strongest growth companies in the US market. On the other hand, you may be more exposed to volatility because the portfolio is less balanced across different industries. Understanding this composition is key before deciding if SPUS fits your strategy. Let us now look at the performance of SPUS. Over the past few years, SPUS has delivered strong returns and in some periods has even outperformed the traditional SP 500. This may seem surprising at first, but there is a simple explanation. Because SPUS excludes financial companies and focuses more on technology and growth stocks, it has benefited from the strong performance of these sectors. During periods where large technology companies lead the market, SPUS tends to perform very well. Companies like Apple, Microsoft, and Nvidia have been major drivers of returns, which has helped boost overall performance. However, it is important to understand that this outperformance is not guaranteed. The same concentration that helps during strong growth cycles can become a disadvantage in other market conditions. If technology stocks underperform or if financial sectors lead the market, SPUS may lag behind the broader index. For investors, the key takeaway is that SPUS performance is closely tied to its sector exposure. It can offer strong growth potential but also comes with periods of higher volatility compared to more diversified ETFs. Now let us talk about fees and costs, which are often overlooked but very important for long-term investors. SPUS has an expense ratio of around 0.49%. This is higher than many traditional index ETFs that track the SP 500, which often have fees below 0.10%. The reason for this higher cost is the additional screening process required to maintain Sharia compliance. The fund must continuously review companies and apply both industry and financial filters, which increases operational complexity. While the fee may seem small, it can have an impact over time. Higher costs reduce your net returns, especially over long investment periods. For example, if two investments generate the same gross return, the one with lower fees will always perform better for the investor. That said, many investors are willing to accept slightly higher fees in exchange for investing in a way that aligns with their values. The key is to understand what you are paying for and decide if the benefits justify the cost. In the case of SPUS, you are paying for both market exposure and Sharia compliance, which makes it a unique product in the ETF space. To better understand SPUS, it is useful to compare it with the traditional SP 500. At first glance, both aim to provide exposure to large US companies, but the differences become clear when you look deeper. The SP 500 includes companies from all sectors, including financial institutions, banks, and highly leveraged businesses. This results in a broad and diversified index that reflects the overall US economy. In contrast, SPUS removes companies that do not meet Sharia criteria. This leads to a portfolio that is more selective and focused on specific sectors such as technology and growth-oriented businesses. Because of this, SPUS may outperform during periods when these sectors lead the market. However, it may underperform when excluded sectors such as financials perform strongly. Another key difference is diversification. The SP 500 is more balanced across industries while SPUS is more concentrated. This can increase volatility and make returns less stable over time. For investors, the choice between the two depends on priorities. If your goal is broad market exposure, the SP 500 may be more suitable. If your priority is halal compliance, SPUS offers a structured alternative. Now let us look at the risks you need to understand before investing in SPUS. Like any equity ETF, SPUS is exposed to market risk, which means the value of your investment can go up and down depending on economic conditions and investor sentiment. This is normal for stock market investments. However, SPUS has additional risks due to its structure. Because it excludes certain sectors such as financials, the portfolio is less diversified than the traditional SP 500. This means that performance is more dependent on a smaller group of companies and sectors. Another important risk is sector concentration. SPUS has a higher exposure to technology and growth stocks. While this can boost returns during strong periods, it can also lead to larger declines if these sectors underperform. There is also what we call Sharia compliance risk. Because the investable universe is reduced, the fund may miss opportunities available in the broader market. This can impact long-term performance compared to more diversified funds. Understanding these risks is essential so you can invest with realistic expectations and align the ETF with your overall strategy. Let us now wrap everything together with a final verdict. SPUS is one of the most accessible and widely used halal ETFs available today. It offers a simple way to invest in large US companies while respecting Islamic finance principles. For many investors, this combination of simplicity and compliance makes it a strong option. The ETF has shown solid performance over time, supported by its exposure to growth-oriented sectors such as technology. It also benefits from focusing on companies with lower debt, which can add a layer of resilience. At the same time, it is important to understand the limitations. SPUS is less diversified than the traditional market, and its performance is more dependent on a narrower group of sectors. This means returns can vary more depending on market cycles. In the end, SPUS is not about outperforming every index. It is about investing in a way that aligns with your values while still participating in market growth. If used correctly within a broader strategy, it can play an important role in building a long-term halal portfolio. If you want to go further and build your own halal portfolio with confidence, I have created a complete step-by-step guide designed for both Canadian and US investors. It shows you exactly how to select halal ETFs, structure your allocation, and invest with a clear plan. Instead of guessing or spending hours researching, you can follow a proven system and start today. You will find the link in the description below. If you found this video helpful, make sure to subscribe for more content on halal investing and passive income strategies.